hour rather than about an hour and a half. Okay. So yes, so when we take on equity, when we sell equity in our company, we actually are selling a percentage ownership, right? But I think we sometimes don't really stop to think about what it is we own. So Garrett, you're the president of the company and you have 20% of the shares of stock. The company has a building, it has some technology, it has contracts with customers and suppliers, it has equipment. Is that what you own, or do you own something else? Because I'm surprised. I don't think I've ever seen you not have an answer. I've even seen you have an answer when you didn't really have an answer, but you want to get one anyway. Okay, well, let's be more abstract about it. I own a company 100%. And the company has, or you own the company 100%, Garrett, and the company has buildings, it has equipment, it has technology, it has contracts. Do you own those if you own the company?
Yeah.
Does anybody agree or disagree with that?
I agree.
Okay. Zach, you shook your head. What do you mean?
I was saying that I agree.
Okay. So if you own 20% of the company, my original question.
I own 20% of every single one of those things.
Is that what we own?
Well, I'm asking, I don't really know.
Pardon me, Garrett?
I'm asking, I don't really know.
Okay, all right. Nickel?
You own that 20% plus the rights to the future cash flows.
Okay. So what is a company? Let's assume this is a corporation for a minute. Okay, it's got a tax ID number, you've got bylaws, you've got articles of incorporation, you've got a name, you're registered with the Secretary of State in the state in which you registered, Utah, wherever it is. I'm going to argue that if you own 100% of the stock in a company, that you do not own the property, the buildings, the equipment, the technology, the contracts, any of that. Am I right or am I wrong? Or how could I be right?
Or if you look at it in a more like micro way, like let's say you're leasing a building, you don't own the building, right? But if you buy the building outright, then you own it. So I guess you could break it down into every single thing.
Okay.
If you do it like that. That's
Yes,
what
but
I'd
I'm
say.
saying in this case, the company owns the building.
Okay.
Nickel?
So, correct me if I'm wrong, but in the US, the company is a separate entity, so you own the company that owns the rights to
Thank you. Thank you. Is that where you were going, Zach? Yeah, so I need, when we talk about companies, I largely think LLCs, which is a corporate structure of a type, S corporations, and C corporations, which are clearly corporate structures, right? There's something called a B corporation. What's a B corporation? A B corporation, sometimes referred to as a benefit corporation, is been on the books of most states for decades, but has only recently started to take any real traction. So let's say that Sherry creates a company, and she is rather egalitarian, and she's very benevolent, wants to be a good corporate citizen in the society in which her business operates. And so she's made a decision to give back 10% of her corporate profits to local nonprofit organizations. She's given back to the community. Okay. If Sherry created that business, and now you guys are her shareholders, in fact, you own more than she does. And if this is a regular C Corp, S Corp, or even an LLC, and she then is a manager for the corporation that you own the majority of, and she is going ahead and giving that 10% of the profits, is it possible that one or some of you could challenge her on that and possibly even file suit against her and win?
Yeah.
How come? What's wrong with giving money to charity?
What if you don't agree?
Well, apparently they wouldn't agree, which is why they are suing you, okay?
You
There
could
you go.
argue that her role is to maximize the profit to the shareholders or something like that, and so technically by giving away money, she's not maximizing the shareholders.
Yes, that's exactly what the argument. Fiduciary responsibility
Yeah,
is to the maximum benefit provided to the shareholders, the equity shareholders. Well, I mean, if Sherry could go back and say, well, we give this money to these nonprofits, and we do this, and it gives us such a good reputation in the community that it actually has increased our sales and our profit more than that which we gave away. She could argue that perhaps. She'd have to back it up. She might win, but probably not. So a B corporation was formed, or the B corporation structure was created. And in the bylaws and the articles of incorporation, if Sherry put together the B Corp, it would state that the corporation has the express purpose of giving back 10% of, or whatever, of its profits, or its revenues, or its margin, or however it's measured, to nonprofits, charities, whatever it happens to be. A lot of latitude as to how you state this. Now, if you become shareholders in that entity, you became shareholders in an entity and you knew that this was going to happen, and you invested in that entity knowing that that was the kind of entity it was. So you can't come back after her. So a B corporation essentially gives cover, legal cover, to someone who would like to be a good contributor to the community and not have to worry about shareholder activist suits, right?
The amount given back to the community, does that have to be specified in the articles of incorporation?
In some way. It can be specified in dollar terms, but that's a little dicey, because if we don't have enough money to make that kind of dollar contribution this year, now we have a different problem, right? Maybe we didn't have enough profits this year to do it. Now Zach, a shareholder, can come back and sue Sherry and say, well, it says we're going to give $10 million. You only gave $7 million, and so you're in violation of your own articles of incorporation. That's a little bit dicey when we do, if we do that. Zach?
Are they allowed to say it's variable?
In fact, it's most often a percentage of some other measurable. It's even, and more often than not, it's a percentage of net income. Sometimes it's a percentage of operating margin, but even that can be a little dicey, because if your operating margins are thin enough, as a dollar value, now you can be in the same problem of being in violation. Or it could be even a percentage of taxable income. It's usually a percentage of net income.
But when you pick that percentage, is that a fixed percent, or can that be variable?
Good question. It's a fixed percent. It would result in a variable amount, of course, but it's a fixed percent. And in order to change it, you would have to change the articles of incorporation and the bylaws, which those are changeable by the board of directors voting for a change, right? So it can be changed, but it's an effort to change it, right? And so once it's in there, it's kind of in there unless you change.
So like when you're writing the contract, you can't say between this and this amount per year, or?
Can't say. Well, I'm not a lawyer. I'm not an expert in these documents. I'm not sure I would say that it can't say that. I would have to tell you I don't know if it can say that. And I've never seen one that said that. I've always seen them that had an express percentage of some other measurable. There was a hand, I missed it. Please, Bert.
What are the benefits of being a B Corp if you're like a shit, like, I get giving back is great and all, but if you're going to do that as a company, right, and most of the people in corporate America are like, is there benefits like tax, is there anything like that?
Good question. So any expenditure of the corporation or the business is deductible before taxable income, right? I think there might be a couple of exceptions to that, but I think there are only a couple. And obviously an expense isn't paying dividends. That's not deductible, but that's also not an expense, okay? So this becomes an expense, and it becomes a deductible expense. So clearly it reduces taxable income, and come back to the concept of tax shield that we were talking about the other day. We talked about tax shield with APV, right? Okay. So tax shield, we talked about tax shield specific to interest expense, but it's possible we could have a tax shield with respect to charitable contributions. Same thing. So you can see that that is a benefit, but even still, $1 given away doesn't give you $1 of tax savings. It might give you 25 or 35 cents of tax savings. So you're still net money out, right? So what other benefit does it drive? do corporations that are very giving, outwardly giving, do they sometimes publicize that?
Oh yeah.
Oh yeah. In fact, you're kind of silly not to, because you have to drive value. And so you publicize it, gives you a good name in the community, gives you a good, you become a better brand, if you will. More people flock to you, higher revenue, and higher operating income. So maybe like a marketing campaign that you would also have publicized, it actually could bring you more than it cost you. Could. Whole Foods. We all know Whole Foods, right? How many of you have heard the term conscious capitalism? Bunch of you. So, and there's even books written by a guy named Bob Mackey. Who was Mackey?
I was going to say, I actually got to listen to him speak this
Did
summer
you?
at my internship. Yeah, he came and gave a full seminar, which was really cool.
Very cool. Did he talk to you about getting sued?
Well, he did not talk about that. Someone asked him towards the end, but it was like a one-on-one thing that I heard. So.
Okay. Interesting guy, bright guy. Okay. Bob Mackey now, I think he's a former chairman now, right? Is who bought it? It wasn't Albertsons. Who bought Whole Foods? Amazon. That's right. I knew it started with an A. And he's no longer the chair. Part of the reason he sold to Amazon is because he gets sued right and left by his shareholders and some employee groups because of the very thing we're talking about. So Bob Mackey develops a concept. He refers to it as conscious capitalism. And it really is just benevolent capitalism. It's being a capitalist, as our society is structured to be, our business society, but wanting to give something back. And he was giving so much back of the corporate profit, and he didn't have a B corporation, that he had a shareholder suit on his hands. Because it was argued that he was giving so much back that it wasn't benefiting them. Giving some back, publicizing it was benefiting them. He was giving so much back that it was actually taking money from them. And more importantly, he had developed this conscious capitalism deal. He'd written a couple of books about this. He was on speaking circuits. There are training programs on this kind of thing. He had diverted a lot of his time, for which he was being paid as the chairman and CEO. He diverted a lot of time away from the running of the business, and the business was suffering, and so they sued him for all their stuff, and they won in a big way. Yeah. Which is a little bit unfortunate, because he was just trying to be a nice guy, a good guy. He thought he made enough money. He just forgot that his responsibility wasn't only to make money for himself, but he had all the other shareholders to make money for. That was his legal responsibility. Okay, so we have this B corporation thing. We have the ability to be egalitarian, but we have a responsibility to be profit maximizers, and we've been seeing all of that reflected in increased free cash flow and increasing value for our stakeholders. When you are an equity stakeholder in a firm that has a business structure, you own some percentage of that business structure. You don't own the things that business structure owns. And that's an interesting separation. In fact, the IRS presses this separation sometimes. So I'll come back to Garrett. So Garrett, you've got the buildings, you've got the equipment, you've got all these things, and you own some goodly part of the company. I don't know that it matters how much percent, but you own some goodly part of the company, and you are using a really nice conference room in the business offices to host a local group from your church once a week, and you even go ahead and provide food for this. I don't know what the function is really. You use the printing presses to print some of their programs for Sundays. You use some of the cars or trucks to do things for the youth within this church and such. The IRS will come back and suggest that business has become your alter ego, and you've now pierced the veil of legal security. And because you made business too much about you and your personal preferences and activities, you now have lost the veil of responsibility, such that now somebody that sued the business, because they're actually suing you. as a person. So the IRS is interesting in its taking a look at what we call alter egos and how you tried to use those business assets that you didn't own, the company owned. But it was clearly you that might have been using it. In fact, so much so that when we look at GAAP, or generally accepted accounting principles, there's a whole GAAP delineation that allows for some of the senior officers and major shareholders in businesses to pay some of their personal expenses through the business. I mean, if you own a small business today, and if it's not paying your cell phone bill, all of your vehicle expenses, your internet fees, buying your computers, anything that could somehow be related to a business function, but that you have them personally, if you own a small business and you don't have the business buying those things, then you're losing some of the tax benefits of owning a small business. But if you do that in generally accepted accounting principles and you're talking to the public about the business, you then take all of those expenses, you categorize them in a personal expense of some kind, and it comes below operating income as an expense. It's deducted after operating income. So it's not an operating expense. It may or may not realistically be a tax deductible expense. If it's big enough, you actually have to receive a statement from the company that says you got all these benefits dollar-wise and you get taxed on them, but almost nobody does that unless it's a big corporation that's very, very formal. If it's Ryan's Clothiers up in Ogden or Layton, he's not going to do that. He's just trying to get a tax benefit. But if you're communicating to other business people, then you have to kind of separate it out. So because those are not really operating expenses, right? All right. We're a little bit off topic, but we want a little bit. So let's talk about leverage still. In the 1970s and 1980s, interest rates were double digit for much of that time period, 10% above. Inflation was high single and low double digits for much of that period. And there were even times when inflation spiked above 17 and 18%. And interest rates were higher still. Yeah, Nichols grinning. You think, how do you live when interest rate or when inflation is that, right? Is that high inflation? 17%? In fact, it's devastating compared to today. If we look at polities across the globe today, will we see some where inflation is greater than 17, even 20%? Yeah, in fact, we see some egregious examples, right? And I don't want to get too much into macroeconomics because that's not the kind of class we are, but that's a suggestion that that nation's currency is being devalued for whatever reason because they've got some significant macroeconomic problem occurring. But even in our economy, inflation goes up and down, right? And when inflation goes up and down, interest rates also tend to go up and down. Okay, there is a direct correlation there. So if interest rates are in the 10, 12, 15% range, what would motivate a company to borrow money? Kind of easy to think about when they're in the 4% range, right? It's the same answer. So why do companies borrow money when interest rates are in the 4% range? Pardon?
Cheap.
Cheap? But isn't cheap a comparative statement? So Mason's a very generous guy. He's a very generous guy. Gives 70% of his gross income away to charities. Lives like a pauper so that he can benefit others. Compared to Mason, I'm cheap. I don't do that. I just don't do that. Brigham, on the other hand, Brigham's a little bit of a cheapskate. He only gives nothing to others. Compared to Brigham, I'm generous. So cheap's comparative, right? And by the way, I don't think either of those things are true of either of these guys. Okay? As it turns out, Brigham's generous and Mason's cheap. So it's comparative to what? Cost of debt is compared to what?
Cost of equity.
Cost of equity, exactly. What was happening in the U.S. stock markets in the 1970s and early 1980s. Woe is me. Okay? It wasn't until the mid-1980s the stock market started to loosen up a little bit as Paul Volcker, the chair of the Fed at the time, was getting a handle on inflation. And that was when Ronald Reagan came to office and such. But even still, for a while, interest rates stayed high until inflation really got beat down to something manageable. When debt is cheap, the cost of debt is cheap compared to the cost of equity, businesses will take on more debt than equity. When equity is cheap compared to the cost of debt, then businesses will take on more equity and less debt, which is part of why the stock markets began to have a resurgence in the mid-1980s, because debt had become so expensive that there was a flocking to equity. And now as more people were demanding equity, when you demand something, the price of it rise. The price is the cost of, right, the percentage of. Think of it as the RE, right, that's the cost of. And so that then kind of reversed that trend. And in your lifetimes, you've pretty much only seen cheap cost of debt and high cost of equity. You've seen a couple of periods in which the cost of equity didn't seem so high. You've seen a couple of periods in which equity prices were falling, rates of return were low or negative, but in the macro, if we take all the years combined, you've seen largely high costs of equity, which means higher returns on equity, and low costs of debt. We got to where it's in low single digits, right? I think a good AA rated corporation today can take on 20-year bonds for about 6%. And that's dirt cheap. That's dirt cheap. We see this in our mortgage markets too, right? I mean, what's the prevailing rate on a 30-year mortgage now? Is it about 4.5%? Something like that? Yeah. You want to guess what my first mortgage interest rate was? And very close, very close. Now, I had good credit, I had great loan to value and debt to income ratios, or debt payment to income ratios. It was 17.8%. Yeah, yeah. On a little fixer-upper on the hills overlooking the San Francisco Bay in 1986, I think it was. Paid $175,000 for this tiny little house that the last I knew sold for about $2.3 million. And I quit owning it at about $350,000, sadly. Okay, if I'd only known, right?
Bay Area, dude.
Pardon me?
So just the Bay Area is.
Yeah, it's the Bay Area. Yeah, Bay Area is nuts. You guys have seen the articles. The Bay Area is nuts. But there's a couple other parts of the country that are equally as nuts. My house payment was $3,000 a month for this little nothing of a house. Little nothing of a house. Yeah.
What was rates for renting back then?
Rates for renting were a little bit less, but not a lot less, because they tend to track. They tend to track. They then plummeted, and when interest rates went down, so did house payments. But then market values started to go up and they started to come back up.
But had you seen rates lower before?
Yes, but I wasn't old enough to have paid a lot of attention at the time. Interest rates in the 50s and 60s, and I was alive during much of that, but not all. Interest rates in the 50s and 60s were in the 2, 3, 5% range. So when you hear about today's rates being at 40-year or so lows, it's because they're going back to the 60s, back to the 70s, before the 70s. Yeah. Okay, so we're talking a little bit too much macro. We need to talk more finance. So when the cost of equity is greater than the cost of debt, companies will take on debt and eschew equity. And when it's just the opposite, they'll take on equity and have very little debt. So now let's think about leveraged buyouts and stock buybacks. Okay? And I'm not going to do some of this with numbers because I think you guys can figure the numbers very quickly, but I want to think about them conceptually, right? So in our WACC equation, we have E divided by V times RE plus D divided by V times RD times 1 minus our tax rate. And that's WACC, right? And I have supposed in this case that this particular entity doesn't have any preferred stock. Okay? if RE is greater than RD, how can a company, by financial engineering alone, not increasing revenue, not increasing operating margins, not increasing profitability, not increasing anything inside of the operation of the company, not managing anything about the operation of the company, how can the company increase its value through financial engineering?
Buy back equity using debt.
Okay, so if I buy back equity using debt, so I raise debt, I lower equity, is it likely that my cost of
sorry,
debt...
I meant. No.
No, you're right. No, you're okay.
Yeah, no.
Yeah, you're okay. Is it likely when I increase my debt that my cost of debt goes up? You're nodding your head.
Yeah.
I think that's probably true. Why would that be true?
Your interest rate is gonna be higher.
Yes, but why? But if my company is gone, let's say we had a debt to equity ratio, or we had, let's say we had 20% debt. And now we moved it to 30. Why is it that the interest rate on debt is likely going to go up for me?
Because you're carrying more and then it's more risk for you to pay off all your debt.
Okay, so there's the risk I may not pay it off, but I still share. I've still got 70% equity in a profitable company. You're the president of the bank, okay? And you see I've got more than enough cash flow. And by the way, in 20 years, when this debt comes due, do most companies pay it off or do they refinance it?
Refinance.
Most refinance it. And so I'm very creditworthy. Is there any reason to think I won't be creditworthy then? So I don't think it's about paying it off, but you're close. What else, Ryan?
Is it being able to make your payments?
Being able to make my payments. So in this scenario, let's say my interest payments each month went for, or each period, 6-month period, went from 1.5 mil to 2.3 mil. And let's say my EBIT was 6 mil before the change. So I already had a taxable income of 4.5 million, right? So I have 6 million in EBIT, 1.5 million in interest expense. I've got a taxable income now of 4.5 million. And that was before the change. And after I take on more debt, I still have, what is it? 3.7. So taxable income, 4.5, taxable income, 3.7. We're still okay, right? See? Am I going to be able to make my interest payments? Bobby, what do you think?
I don't know.
Okay? Well, I think that if I still have a $3.7 million taxable income after making the interest payments, I think I'm okay, right? Yeah. In fact, what do you say, because I like this, and improved my WACC, didn't it, when I did that? Because if RE is greater than RD, and we got rid of some of the weight for equity, increased the weight for debt, even if we had a modest increase in RD, I think WACC went down. And I'm going to do this to represent the modest decrease in RD. I'm just going to give a little, or excuse me, a little arrow instead of a bigger one. So I think that interest expense doesn't increase in the same ratio that debt increased. It increases in a lesser ratio, certainly when we're in the 20 to 30% debt to equity rates, okay, or relationships. We probably went from this maybe being a 6% interest expense to 6.1, 6.15. So not a big change, right? So I like that. What do you say we get a little bit more aggressive? And because I've still got $3.7 million worth of taxable income I can spend, right? And by the way, when WAC went down, what happened to value? Who said increase? Why do we think it increases, Ryan?
Just the house rate construction.
Think about where the discount rate is in the equations. So when the discount rate falls, the denominator gets smaller, and assuming the numerator didn't change, the value of the entire term rose, right? So in this case, financial engineering, we didn't change a dime of revenue or create another unit or sell anything more. All we did, we went to the financial markets, we changed some of this relationship, we increased our value. It's almost like alchemy, right? Or smoke and mirrors. Does it happen? A lot. Why do we experience stock buybacks as rapidly and as readily as we do any longer? Do you suppose we experienced stock buybacks in the early 1980s and 1970s when interest rates were double digit? We didn't. We didn't experience stock buybacks because stock buybacks largely mean you have to increase debt. When RE was less than RD, you have just the opposite perhaps. We saw companies issuing stock in order to pay off debt. Just the opposite, because of the relationship that existed. Okay? So let's take this a little bit further. Let's take it to 40%. Yeah. And we still have 6 million here. Let's say that this probably moved us to about, I'll say 3.5 mil. These are our interest expenses. So our taxable income now is 2.5 million. What are we thinking? We like it still? Yeah. We decreased equity even further if we used all the money we raised to buy back stock, right? We decreased equity even further. We increased debt more. Yeah, RD went up a little bit more. Maybe it went from 6.1 to 6.2 or 3. That's still nominal changes, right? We increased or we decreased WAC further. We increased value more. Are we approaching a problematic point? What are we doing, Ryan?
We're getting our taxable income down to,
I don't know, $2.5 million, that's a lot of money. To me, maybe not you. I mean, you dress better than I do. That's maybe not to you.
well, also the issue is that we will get to a point where RD increases to a point so that they are actually driving down. Because as you take on more debt, the cost of.
I liked your first answer better, by the way, because you were right. I never challenge you if you're not right. Can I help, guys?
I'm a little confused
Okay.
on how WAC doesn't just even itself back out. Like, if the cost of equity is going down, debt's going up, like, wouldn't it just find the same point again?
It's the proportionality. If the cost of debt went up at the same proportion that debt went up, WAC would stay constant. But the cost of debt goes up a little bit, even though we've been increasing these. So I think we said we went from 6% to 6.1, but we increased our debt by 50%. We didn't increase our cost of debt by 50%. If both of those proportionally increased, it would cause WAC to remain constant. But they tend not to. They tend not to. For a creditworthy entity. For a non-creditworthy entity, that might be different, right? Good question, by the way.
But the cost of our equity is also going to go down a little bit.
Why?
I don't have any here, but
Why?
just because we have less of it now, we have less equity.
That doesn't mean the cost of equity is going to go down. Remember, in fact, I think the cost of equity went up. if the value became greater, doesn't that suggest the return on our investment as investors became higher? And it's not because the debt return became much higher, so we're going to see the excess return show up in RE. In fact, this is all about finding ways to synthesize increases in RE rather than earn them. And I'm getting a little loose with my commentary now, right? I mean, they are earning it because the finance guys that are doing this, the investment bankers, the lawyers, say, gosh, I earned this for us. CEO earned it. In fact, he earned enough that he got a big bonus. You gave him an extra $10 million in bonus this year. Thank you very much. So I don't think that RE does go down when equity goes down. In fact, more often than not, it goes up because we have a lower expense, or we have not a lower expense. We've changed our value. So that's how you think about it. How does it affect value? And when value rises, the return on our investment rises, and that is a notion of RE. Zach?
So, can you just kind of explain why the cost of equity would be going up? Because when I'm thinking about it, those are all determined kind of by the market, or am I?
Okay, no, you're right.
So-
But let's come back to this. If the business
It goes like a company.
had been worth 20, I'm not using these numbers now.
Okay.
So let's say the business was worth 20, the whole value of the business. And the business's debt was 3, had a market value of 3, that would suggest the business's value of equity was about 17 minus cash. Fair enough? Okay. If the value of the company rises to 30 and the value of debt went up to 4, I now have equity value at 26. RE goes up. Because what was worth 17 in the hands of shareholders is now worth 26. That means the return on shareholder investment went up a lot. I'm being a little bit grotesque in these numbers, right? They're a little obtuse, but they're just trying to show you a point. Brigham?
Is this usually what you see with issues with like CEOs and other people where they're kind of, messing with this equation and stuff? Because I could see that you could easily get highly leveraged in debt, right? Increase that equity. Because to me, like, I kind of see where everyone's a little bit confused saying like you're literally just bouncing back and forth, but I see how it goes up. But technically for the company's sake, aren't they just bringing on more debt and it's going to increase the cost of equity, right? But that's mainly going to, line your pockets if you're the one doing that, and then the whole thing along will be beneficial, but that's more of a gamble.
So you're actually coming to the point where we're marginally getting to, because I was going to take us to 60% debt and test our premise for a minute, and we'll do that in a second, okay? Because now we're really getting leverage, right? So what you're talking about clearly is the effect of financial engineering, and you're talking about whether or not that's really changing long-term value. You didn't say long-term, but I'm going to introduce that concept, right? Can we see that it changes short-term value? Absolutely. Okay, it's hard to argue that because we have all of our really cool-looking equations, right? But what changes long-term value? Remember our discussion about where do we get sources of ROIC and growth? We didn't include, remember that was M&A, organic growth, maybe macroeconomic concepts, scale of populations, innovation, etc. I don't think we included financial engineering in that, did we? Financial engineering will give you short-term changes in your valuation, but markets figure it out. Markets figure it out. And longer term, we'll bring it back in line. In part, and here's what the market figures out. This comes back to Sherry's concern about the risk. Let's assume here at 40% debt, 20% debt, 30% debt, we still are okay. We still got some nice taxable income. In fact, we could, if we wanted to, have our interest expense go all the way to $6 million. And we'd still be solvent and safe as a company, wouldn't we? And we wouldn't have any more taxable income, but we're not losing money. And we've boost our value so much that we're the board of directors. And the shareholders now think we are kings and queens because we have made them wealthy along the line of making ourselves wealthy, right? If this story continues. I don't know what the number is. I'm not going to give us 20 or 40 or 60, whatever percent debt. I'm just going to say that as we approach having interest expense that becomes closer and closer to our EBIT, we have really juiced our value. And to Sherry's point, we've increased our risk. And I'm going to say it's not necessarily only the risk of being able to pay it back, although you get to a point you are starting to risk that. I think we are running the risk of not being able to make our interest payments. Why might I say that? Because let's say that we took our interest expense to 5.7. We still have $300,000 taxable. We're okay, right? We've got operating margin. We've got taxable margin. Why is that risky? Right?
Because don't you assume that the following year you're gonna have a large EBIT as well?
Oh, you want to think about the future? Yeah, so this EBIT, love the EBIT, right? Does EBIT always go up? Does real estate always go up in value? I know EBIT and real estate have nothing to do with each other, right? But does real estate always go up in value? No, in fact, if I'd asked that question 11 years ago in a class like this, 11 years ago, 2007, no, it better be 12 years ago. In a class like this, the answer, oh yes, you guys would have been absolutely convinced.
I think even adjusted for inflation, you're wrong. Doesn't it always go up? Haven't we always seen an increase? If we look at real estate value today compared to even pre-2008.
Yes, but some of us lived through 2006, 7, 8, 9, and survived, okay? And if we were having this discussion in 2010, and all of you owned homes, and your mortgages were of greater numeric value than your houses, you wouldn't be arguing that point. Over time, do we tend to see that real estate is a decent real investment? Yeah, sure. Over
Yeah, that's what
time.
I'm asking you.
Yeah, we do, yeah. I think largely inflation adjusted. In the 70s and 80s, not inflation adjusted. Inflation was kicking our rear ends, okay? But by and large, long periods of time, and I would argue that we are better corporate citizens when we think in long terms, but we are human beings at the same time who receive incomes in short terms. We get paid once or twice or 3 times, whatever it is a month, right? Or at least a few times a year. So you can't forget that. Will our EBIT be enough next year to cover this? This is not going to change. It's not very forgiving, is it? So if our EBIT goes down to 5.6, we got a problem, don't we?
Did you just give that number 5.7?
I just gave it,
Okay,
yeah,
okay.
just
Okay.
a number.
Okay.
I didn't critically calculate.
Yeah, no.
But if our EBIT went down to 5.6, well, how hard would it be for our EBIT to go down to 5.6? Well, not all that hard, right? If we enter into a recession, if our industry has a contraction because we were in the carburetor industry, and now everything's moved to fuel injectors, or we're in the fuel injector industry and everything's moving to batteries, right? Okay, lots of things. Didn't have to be a recession. Or we're in the apparel industry, and we make the mistake of hiring a professional athlete whose reputation doesn't do for us what we thought the reputation was going to do, and we lose $3.7 billion in market value the next day. Okay, and I don't know what the number is, but the loss in market share for Nike and the revenue loss in the following periods has been dramatic. Interestingly enough, I only learned this the other day. What's been the increase in revenue and therefore value for Adidas? Any ideas? Pardon?
Nike's stuff going on.
Well, Nike's suffering, and when one clothing manufacturer in men's and women's casual athletic clothing goes down, unless the appetite for that kind of clothing goes down generally, the other firms pick up the spoils, right? But not too long ago, who did Adidas sign to help rep some of their wares?
Oh, yeah.
Kanye. I'm sorry. I thought he was a country western singer. I didn't know he was around.
Kanye West.
Yeah, Kanye West. I didn't know, well, West. I thought country
That's
west.
where you got the Western part out.
Yeah, I know. So apparently I don't pay a lot of attention to that kind of stuff. Kanye, the single largest effect on Adidas's revenue as a percentage that they've ever seen, larger than any given product line. Kanye. Right?
It's almost secret.
Sounds so
Say it
natural.
Pardon me?
It sounds so natural.
Go YouTube some of his music today.
I'm sorry, what?
I said go YouTube some Kanye West music today and listen to him.
Yeah, we have a disconnect. Because now that I do know who Kanye West is, the concept of music
He's not really.
and Kanye West, not so much for me.
Who do you think?
Beethoven, Vivaldi, the Beach Boys, the Beatles,
Beach Boys.
Fleetwood Mac, music. Kanye West, maybe not with music. Yeah.
So would you say a lot of companies that are engaging in stock buybacks right now are pretty optimistic about the next 4 to 5 years?
That's another element of this. Let me finish off this real quick and then let's go there. Okay? All right, so the risk sharing comes in that any economic event that causes their revenue and therefore their EBIT to bobble a little bit, to reduce, the closer the interest expense is to that, the riskier they get, right? And it doesn't take much of a shock, external or internal, in the case of a decision made like by Nike, right? Or when Coke decided, you guys aren't wedded to Coca-Cola as a product that's been around for generations. Let's change it and let's make it new. You're going to buy more of it. Not so much with that. Or Pepsi, and let's make it clear. You know, Pepsi doesn't have to be colored, it can be clear. Just terrible internal mistakes, right? Those weren't external shocks. In fact, had Coke not backed off of the new Coke marketing that they were doing, and they not brought back classic Coke, they'd have waited another 6 months, Coke would have been gone. Coke would have been done.
What did they do to change Coke? I don't know.
Oh, this, I'm sorry, you guys don't know what I'm talking about. Do you know?
Yeah.
Yeah, how many of you know,
They-
you guys all know Nancy Panos-Schmidt, right?
Yeah.
Nancy's got some great stories, because Nancy's even older than I am. Believe that? Okay. So about
It was like,
about 30 years ago, I think. Wow. Some brainchild in the brain trust at Coca-Cola, which is a brain trust. I mean, these guys have it going on, right?
Yeah.
Had a marketing epiphany. Let's make a new Coke. Let's make it better. In fact, we all agree. We're the board of directors. We all think it tastes better. We're excited about the marketing campaign. We're going to put tens of millions of dollars in this marketing campaign, and it's new Coke. And you guys that love Coke, you're going to buy more of it because it's better. Well, it wasn't such a great idea. It was a big marketing campaign, and the hue and cry to bring old Coke back was unbelievable, and Coca-Cola sales just went off the cliff. What they liked was Coke. At the same time, a lot of the population liked Coke too. But what they liked was Coke, okay? And they didn't want it to be changed. They didn't want an improvement on it. And it just about cost the company.
That dude was fired, right?
You know, I don't know this. I would hope so. In fact, I'm sure that the marketing person was. Within about 3 years, 2 years, the CEO, chairman and CEO both retired. So yeah, I think you're right. I think they were fired. Because that retired sometimes in upper divisions of corporations means fired, right? All right. So you can see then why some of this financial engineering might be able to drive value, but at a point, a little bit more can actually start to destroy this, because if we get to the point where even if we've got a lot of EBIT, but we're out of taxable income, or we've got more interest expense than EBIT, and we're driving a negative net income, negative taxable income, we don't have increasing value. Because remember that, yeah, we might be messing with decreasing WACC in some respects, but when we start to get that risky, now RD will rise at a proportionally greater than the increase in D, and now we've created another problem for ourselves, right? And if we don't have good cash flow, if EBIT's great, if EBIT's not enough to cover all your tax or your interest expense, we don't have enough cash flow, we don't have long-term value, do we? So it becomes a very risky proposition. We're going to look, maybe today, maybe not until Monday, I'll give do a numeric example of a leveraged buyout. And so you can see this not from the standpoint of internally engineering the company's finances, but why it might be interesting for Zach as a corporate raider that's got $50 million in his own cash, he and his investors, to come in and buy Mickle's $200 million business by giving $50 million to him, borrowing $150, paying him the $200 million, and then taking $30 million of the cash he's got on hand to pay themselves back. And he created possibly value in doing it. Created a lot of value possibly in doing it, except for if he's got a little too close to the edge, where he couldn't afford his interest payments. Well, we'll go through a numeric example of that. Maybe today, maybe not until okay? One of you said something a second ago. I said we're going to go there next, and now I forget what it was.
So I'm saying, do you think a lot of companies are overly optimistic that next year?
Thank you. Okay. So I want to look at a couple of other ways and reasons that companies will buy back stock, and then which dovetails into this. Okay. So you are CEOs, and you know that you came to this conference today to find out how to really maximize your shareholder value. And you guys each have substantial amounts of cash on your balance sheet, far more than your normal operations require. In fact, on average, you guys have about $100 million in cash on your balance sheets, and your corporations do just fine with about $20 or $30 million in cash. And cash, it helps lubricate transactions, right? It's part of our net working capital. So you've got arguably maybe $70 million on average each on your balance sheets, more than you need. You've got some shareholders that are saying, give some of that cash back to us in dividends. Or a different way of giving a dividend is buying back stock. Because we can use cash, buy back stock. Either one provides cash to shareholders, and buying it back provides a lot of cash to some shareholders and none to the ones that didn't sell their stock back, right? But to those, there are now fewer shareholders and greater value, so they didn't get cash, but they got value instead. Okay. So they might be wanting you to do that. Brigham?
Would companies always want to go with that option, I would feel like, because cash is leaving the companies. It's like kind of the concept of employees getting a discount their own work. Don't you always want to, if you're a company, you give out cash or give out your stock, you're going to give out your stock hand over. Won't you do that every time? Like, when would that be?
I don't know that.
Okay. Because I don't see a negative in this. Well, I guess there could be negatives, but I don't see, like, would you rather just give out cash that potentially won't go back into your company, or give out stock at that same rate of cash?
Give out stock or buy back stock?
Buy back stock. Because to me it seems like a no-brainer to be doing that.
I think it has at least something to do with the return on cash and the return on equity, or RE, but it also has to do with, does it cost us something to do it? So if we give out dividends, we give out $10 million in dividends, it costs us $10 million, right? Or maybe it costs a little bit more than that because our finance group has to cut the checks and do all the accounting of it. So, but let's say it costs us $10 million. But if I want to buy back $10 million worth of stock, and if that's even 1 or 2% of the outstanding stock of the corporation, I have another expense. Do you guys know what it is? Can we simply decide here as CEOs to go buy back some of our stock, and then on Monday morning go ahead and start buying it back in the open markets, willy-nilly?
Don't you have to, like, so there's some kind of communication to the stockholder on who's gonna sell their stock?
Yep, so we have to announce it. And when we announce it, what happens to the price of the stock? It's gonna go up some, right? We have to file with the SEC, so which is part of that announcement. And so Kira, Cower and Associates, the big New York law firm that's handling this for us, and Jackson, the investment banker that's handling this for us, because we didn't do it just by telling the CFO, why don't you go to your E-Trade account and buy back all the stock, right? So these are big transactions, and between you guys, you probably charged us about $3 million.
Okay, so I guess I can.
So there's some transaction cost that probably goes into that decision. So I don't think it is just that no-brainer. Okay. But when we buy back stock, we're signaling, but because we have excess cash, we're signaling some things to our investors and our board of directors. One of them is we have excess resources. Another is that we as CEOs and managers can't think of anything to do with that money that's better for the shareholders than giving it back to them. We can't think of ways to invest it. We can't think of innovations. We can't think of ways to increase the company's value otherwise more than giving them back cash. Now, I don't know about you, but I like my $7 million salary and the $30 million in stock benefits I got this year. Okay, I think you guys, good CEOs, you like it too. At those prices, don't you think that our shareholders suppose we can find good, creative uses for cash rather than just giving it back?
Does the same go for individuals within the company?
What do you mean?
So if I'm a CEO and I don't buy back stock on behalf of the company, I actually buy back stock for my own purpose. I go on my E-Trade account and I buy more stock with that, because that's, you also have to
yes.
signal that, right? You have
Yes,
to tell it.
so I think what you're asking, do we still have to go through some of the regulatory and public disclosure requirements
Yeah.
when corporate insiders do it?
Yep.
Yep,
And does it
absolutely we do.
affect the market as much as?
Absolutely. Oh, nominal amounts, you can buy hundreds of shares, maybe a few thousand. But if it's going to have an effect on the stock's value in the market, if it's, I think the technical rule, if it's 6% or more, you have to, regardless of what's going to happen. But even 6% is a lot, right? But yeah, corporate insiders, before they do anything with stock purchases or sales, need to make sure they're very well aligned with regulations and public disclosures. And if they're making this decision because they know something that's going to happen to the corporation, and let's say, I know that our chief of sales, our senior VP of sales, Zach, is about to sign a $15 million contract with the government. It's going to give us $7 million in profit. It's going to cause our stock to go up. So I'm going to go into the market. I'm going to buy some of our stock in advance of that. We call that insider trading, and I'll go to jail, and Zach will do my job. If I'm the one that does it. If I go and buy stock in the market because I know something's about to happen in the company that hasn't been made public yet.
Even if you go through the necessary channels?
No, if I go through the channels, I'm okay. Because going through the channels makes it public.
Even makes what you know.
Yep.
public?
Yep.
Well, never
Then you have to answer questions like, why would you
they won't
buy
allow
stock
it.
now?
Like, if you knew something like that and you went to the channels,
But going through the channels makes the information
well,
public.
then your company's gonna be ticked off at you because you just made it, right?
Well, no. In fact, how many of you know that Elon Musk is in some deep, deep trouble?
Yeah.
Yeah.
Or you just
He settled, but he's
But
still paying
a
out.
bad settlement for him.
And he-
Well, I guess it
Well,
could be
Tesla
worse.
soared afterwards, so.
Elon Musk is in deep, deep trouble. Okay.
Didn't he have that whole thing where he settled and stuff? He lost his
Yeah,
shares.
Elon Musk is in deep, deep trouble.
Okay.
Okay. Even when my attorney gets me out of the obvious trouble, I got to remember what got me into the trouble. Elon Musk is an innovator, he's a visionary, and he's probably grown a little too big for his britches. And he's going to tweet something. Right? Because that's what he was doing, and he was saying at press conferences and such. He said things he shouldn't have said. So, getting himself out of that one little pickle, the guy still has a problem. I think. Okay. And so does the stock price.
No. Stock price went right up again after he settled. It bounced down to 260 at one point, and then as soon as the market opened on Monday, it bounced right up to 300.
Where is it compared to its high? Is it near
Right
its
on
high?
it.
Okay, all right, I'm wrong. Okay. Wow, it's the first time today.
Saying that he could take the company private at $4.20 a share because he likes the number 420, I don't think it's stuff like that that's gonna keep getting him in trouble because he's trying to drive stock price up.
Yeah, he needs to quit speaking in public and tweeting. Kind of like somebody else in the upper echelons of government. All right,
Text messages after the day.
say again.
Text messages after the day.
You heard about that? Donald Trump can now text anyone through just like a public alert system. Like everyone's just gonna get a text. It's just gonna be from Donald
Wait,
Trump.
really?
Yeah,
12,
but it's only in
Hang on a
like
second, hang on a
serious emergency.
Francesca, is there an apartment in your parents' house? If I go next week, I can stay. Okay,
I didn't hear about that.
we're getting way off the subject here. Now, let me come back.
That's crazy.
So when we expend large amounts of our corporate cash and simply give it back to the investors, either in a stock buyback or in dividends, we are signaling to our investors and the public at large that that's the best thing we could think of to do with the money. Now sometimes that's because our investors want the money. They say, hey look, Alphabet, you got $262 billion on the balance sheet in cash. We'd love to have some of it back. You guys probably shouldn't give all of it back, but $50 billion. It's not going to change your ability to run the company. It's not going to change your ability to invest in innovation, but give some of it back to us because right now, sitting on the balance sheet of the company, it's earning you diddly type squat, right? Because cash earns almost nothing in terms of interest rate. Maybe half a point, maybe. So unless it's that kind of a scenario, we're telling the shareholders we can't think of anything better. We can't think of ways to grow the company with this money we have. We can't think of ways to innovate with this company we have and create more value for them than just giving cash back. And that's not a good sign to send to your shareholders who are paying you substantial amounts. Remember my $7 million salary and $30 million stock benefit? Okay? I want to keep getting that and more, but if I can't evidence my creativity, my ability to return more to the shareholders than cash alone would return to them, then they're going to start investing in cash and not investing in this company, right? And when shareholders turn to cash rather than equities, what happens to the equities market? When the shareholders start putting their money in cash rather than equities. Now, at the same time, the interest rate market's good because you don't need to motivate savers by interest rate. They're motivated because they think there's just less value elsewhere. Okay. But that's not the whole story. There might be more.
Two questions. So the one earlier you said when they announced the stock buyback that the share price is going to go up.
Yes.
So then how did it, is it just at random that the people that they buy the stock back from, or how is it? So if I'm,
Oh, good question. So when a company wants to buy back shares of its stock in the open market, how does it do it?
Just the bid and ask price.
Yeah, not even so much that. Typically a tender offer, T-E-N-D-E-R, tender offer. Yeah. And it's public, gone through the SEC, the State Departments of Securities for every state in which there are shareholders, which is virtually all of them in most situations. And those shareholders that would like to tender their stock can then send their stock to the company in exchange for the dollars per share that was agreed upon in the tender offer. Is a tender offer or a company offer like that typically at the same dollar value per share as the market's value on the day it's announced, or is it lower or higher? Higher. How come?
to incentivize people to,
Give them incentive, okay? What else?
To show that they think the stock is worth more than it's really selling for.
There's a little bit of that. but there's something behind that I'd rather kind of get to. Mikkel?
I'm not gonna say anything that's behind that though.
That's okay, there's other reasons.
Yeah, no, so usually you want to buy from as few investors as possible, right? Like as few owners as possible. So you want to have an incentive for the owner, so you don't go out and buy from
Yeah,
6
that
other
might be
owners.
true. I haven't really thought about that. I can't immediately see why that would matter, but it might be true.
It would matter because if you want to go and buy a lot of shares right away, and you look at the order book and you only have so many orders outstanding, you.
But you're now thinking about actually doing it in the market, like going to
Yeah,
your
no, so I'm
E-Trade.
saying that you don't want to do it in the market.
Right.
You want to do it with someone that owns a lot of stock and can give you the transaction right then and there on the set price.
Yeah, and usually tender offers are announced and there's a period of weeks or months during which they're effective. So it's not quite as immediate as we might think. So I don't know if that's a reason or not. I'm not saying it's not, I just haven't thought about it enough to know how much of a reason it would be.
Could be wrong with this, but on tenders, it has to be like a set number, like you say, we're trying to buy this.
We're buying
much,
1 million shares at $40 a share.
But if they don't hit that, I thought that if you put up your money to be part of that tender, it's just money that's, I don't know how to explain, like I feel like if they don't hit that exact amount of shares, it doesn't go out,
It
right?
depends.
Okay.
So our company might say we want to buy $1 million a share, $40 a share. The stock's currently trading at 36, so it's a 10% premium about. Okay. But we may say that if in our offer, if we only get 600,000, we'll still execute.
Okay.
Okay, so there's parameters that exist. That
If the buyback price is higher than what the stock is currently trading for, do people like buy a bunch lower than sell it back?
good question.
And is that legal?
So it's legal, and probably not, because if I have offered to buy this $36 a share stock for 40 bucks, what is the next trade in the market going to be at? 36 or 40?
40.
Market adjusts virtually instantaneously, adjusted for time value of money, adjusted for what the market thinks is the likelihood the tender is actually going to be executed.
So is that why you say value goes up when they issue the buyback?
Well, that's a reason, but there's two things that are underlying this we haven't hit on still, so let me just give them to you. When there is an increase in demand for any given item, what happens to its price? Think as economists. So it goes up. So supply and demand all by itself is going to drive that puppy. But there has to be something that underlies why demand thinks it can aspire to that value. In today's market, if we're buying back stock, whether it's by cash that has a very low benefit to us, right? Or by having taken on debt, which has a very low expense. And remember, benefit and expense are the exact same thing, just looked at from two different perspectives. We changed WACC and we increased value, right? So I can justify the $40 because I think that the firm is either worth that by having done an internal valuation based upon what's going on, or I can pay it because I know that if I'm going to go out there to get everything I want, I better give a higher price, and having given demand to the market, it's going to cause the price to go up. But the price shouldn't go up any greater than the underlying value of this would suggest, right? Because the moment it does, Mikkel, who's a smart guy, looks at this and says, oh wow, this thing's out there at 40 right now. And I've done a valuation, it's only worth 38. Mikkel, what are you going to do? You're just an independent investor out there. You see a stock trading at 40 and you think it's only worth 38. What are you going to do?
Short it.
He's got to short the company. And I went to Mikkel because he was the one to talk about shorting a couple of days ago.
Unless I'm Rick Askel. But
Yeah, I'm short. I bet on America. I don't bet against them. Yeah.
So buybacks reduce the total
I
number
said that in a tweet, by the way.
of shares outstanding, right? So-
Buybacks reduce shares outstanding, so what else happens?
So if your value is at least consistent, then the price per share would go up as well, right?
Yes. And markets, so let's make sure we all understand what he just said. Stock prices very often are a function of earnings per shares and price-earnings ratios, right? In fact, very often. If we have fewer shares outstanding, but the corporation's aggregate earnings didn't change, the earnings per share rose, right? We changed only one of the elements, we increased the earnings per share, because there's fewer shares to split the earnings. Unless the price earnings ratio that we would expect changes, then the stock's value went up. But we have to think about, why does that relationship exist, and why does the EPS ratio exist, and why is it consistent? This is one. You guys might sit here thinking of that, all these valuation metrics and the whole discussion, production value, all this kind of stuff. By the way, I'm writing your paper as we're talking. And all this kind of stuff is just numeric, and it's because I want you to be valuation consultants and all of this, and it's not. It's economic. These are economic principles coming to light through equations and the outcome of equations. That happens. EPS is valid because when we did it, it increased the value of the thing, which actually just pumped the stock price even more than the earnings ratio interaction might have.
So a broader valuation model question then, so if a huge indicator of your future cash flows is something that can be considered super volatile, right?
Say that again, please.
So if your projected revenues,
Okay.
right, is something that could be super volatile
Mm.
because you're in a market where things go up and down sporadically, or if there's an economic downturn or something like that, how often would you be running valuation models then? Like,
Am I the company?
or
Who am I?
as the company, like if you want to determine your value, the value of your firm.
As a company, I probably only think about the value. I try to identify through some external metric the value when I'm preparing for a transaction of some kind.
Okay, so then if you're someone who's working in M&A for a bigger company and you're doing constant valuations on something you're thinking of acquiring, then what?
So I'm going to do it all the time. Or if I'm Matt Krause. How many of you know Matt Krause? Some of you will get to know Matt. Matt teaches Finance 412 advanced investing topics. And it's a 2-credit hour elective that it's very worth taking, okay? And Matt's a former hedge fund trader and manager that has been written up in the Wall Street Journal twice, so the guy's got game, he knows what he's talking about, okay? Matt doesn't use these particular models to value a stock. He uses other models to value the stock. Remember, these models are to value the whole company, not just the stock, right? But Matt's always looking at his models to identify whether or not his models show a value for the stock that's greater, equal to, or less than the stock's currently trading at. And if it shows that the stock is less than, the stock is trading at less than what he's valuing it as, he buys the stock. And I don't know that Matt shorts. He might. I don't know. He might.
So I guess what I'm thinking is like if the underlying value of any given company is fluctuating a lot, how reliable can we look at these models?
It's not fluctuating a lot. I make these fluctuations seem really big, just so you guys can clearly see them. They're really very small fluctuations.
Well, I mean like for a company that is buying or selling securities, or let's say securities are and I'm talking like bundles of mortgages, right?
Okay.
That we're a bank that buys and sells these bundles of mortgages, and the underlying value of these mortgages is the property value, and that property value is going up and down and being constantly rated.
And the creditworthiness of the borrower.
Right. Okay. So then could you accurately run a valuation model for a firm like that?
Could we? I would have to say I think the answer is no. I don't think you can for a firm like that. And I'm going to say that because we've not known any groups to do so credibly, consistently, because the underlying elements are so incredibly complex and so fickle. Okay? We never imagined that if a homeowner's mortgage was bigger than their house, that they would walk away from their house. That was, and you guys probably thought, well, why wouldn't you, right? If all of a sudden you own $500,000 for something that's only worth $300,000, you can just walk away, no harm, no foul. Why wouldn't you, right? That never entered the collective consciousness. Why? Why is that, Mother? Why would we never have thought about that prior to about 2007? Let me change the verbiage. When I walk away from my home, the difference to walk away from a house and it is to walk away from your home.
If you own it, you're proud of it, you want to keep it.
It's not just an asset anymore. It's where I raised my babies, all this kind of stuff. And when I say we, I mean the investment market collectively, didn't see the homeowner trend that was such that people were buying and selling houses rapidly enough, moving often enough, that what had been a home to me was a house to someone. And a house, the person would walk away from. They only expect to live there 3 or 4 years anyway before buying another house. Whereas to me, a home, I was going to buy my home, I was going to stay in my home for the rest of my life, see my grandchildren, kind of thing. Very huge societal shift. We didn't expect the effect it would have until it slapped us in the face with more. Okay, I want to go into talking about an LBO model, but I don't have time, so let me just kind of talk through some of the elements of it, and then we're going to work on a model together on Monday. It's a leveraged buyout model, in which through that model you can model the effects of stock buybacks as well. Because even though they aren't the same thing, they share so many of the same concepts. So here's the story. Cower Industries, $100 million valuation. Sherry Zhang likes this company a lot. Cower has, I gotta start keeping track of my numbers so I give you a consistent story. So Cower, did I spell that right? $100 million. It's got cash of $20 million on the balance sheet. It needs $5 million of that cash.
Can you switch markers here?
Pardon?
Can you switch markers?
Yeah, you bet.
Thanks. Sorry about that.
No, it's okay. Better?
Yeah.
So the next thing he wants me to do is write better. Even though you can see it, you still can't
I
read
don't want
it.
to go that far.
Okay, thank you, appreciate that. And it has no debt. It's all equity. What's its enterprise value? 80. So TV, we would look at this, say market cap of the stock, right? Minus cash is 80. But that is the stock's price. Why do we subtract cash from the market cap of the stock and the market cap of the debt to get to enterprise value?
Because when you buy, or assuming if you buy it, you're just going to get the cash back, and it's going to, you're buying cash.
Yeah, so or at least you could get the cash back if you wanted to, right? Well, if I go in and just buy her stock, or I buy half of her stock, is your CFO going to cut me a check for $10 million in cash? You're never going to allow it, right? So there's a bit of a disconnect there. But it's the LBO concept that we see this play out so clearly. And leveraged buyout and private equity and M&A are almost inseparable in what we're starting to look at here, okay? So, all right, I come in, I'm a corporate raider, and I offer $120 million for your $100 million asset that has an enterprise value of 80. So at least a 20% premium to the stock price, right? But I only have in cash $24 million. How am I going to buy her $100 million asset for $120 million if I only have $24 million in cash? And when I say I have $24 million in cash, it might be mine, or it might be mine and the investors that I represent in my private equity fund or leveraged buyout group or whatever it happens to be. Okay? How am I going to get to the 120 if I've only got 24? I take out a loan. I think it's 96, is that right? Okay. So now I came up with $120 million. Kira, for whatever reason, you said yes. You liked my 120 more than you liked your 100. Yes. And now I own the company. And now the company has $96 million in debt. With some equity that I've got. The company has now $44 million. And it's now apparently worth 120. And it's my company now. What's happened to its enterprise value? Well, we got to think about this. I'm not sure that we can say that the stock's value is 120. Because the enterprise value, if the stock's value is 120 now, we have 120 plus 96 minus 44. That's a much, much bigger number than the 80, right? So I don't think we can do that. I don't think the stock's value any longer is 120. The stock's value is a lot less. How come?
The debt?
Pardon?
Would that be a factor of that or no?
Well, yes, but I'm not sure it's the factor the way you're thinking about it. Did I have a, think of stock as equity, did I have a $120 million equity transaction? I didn't. I had a $24 million equity transaction. So now, 24 plus 96, so 120 minus, is that right? 120 minus 44, and I think we're now at enterprise value of 76. So our enterprise value actually went down, didn't it? It's kind of interesting. But what happens to my investment? I'm looking at this and I'm going to say, okay, I invested 24 in equity. Could I possibly have the company's cash buy out my equity now? Could I go ahead and take $24 million of cash from the company's balance sheet and give it to myself and still have left enough money in the company for it to operate? Sure. So I spent 24 of my own cash. I then took, and I'm being very obtuse about this, okay? It would never be in these proportions. I then took back 24 in cash, such that this is now back to 20. My equity investment now is 0. And as long as the company is still worth something, what's my return on equity? Well, actually it's 0, it's immeasurable, right? Let's be a little more realistic. Let's say I only took 20, so we are now at 4, and this is 24. So I still have a $4 million investment. Even if the equity value of the firm went down to 8, I have a 100% return on investment. That's a leveraged buyout. Now I have another problem. I've got interest expense on $96 million in debt. Let's say it's only $10 million a year. And the company was producing $11 million in EBIT. I'm okay, right, Kara? $11 million in EBIT, $10 million interest, I have $1 million in taxable income, I'm okay that year. Until, right? That's the difficulty with the leveraged buyout. Now, I was willing to do this, I was willing to take the risk, and as it turns out, this was your baby, right? You created this from nothing 20 years ago when I don't even know if you've been thought of yet. How old are you?
20.
Okay, you were just very innovative at a very young age, okay? You created this thing, blood, sweat, tears, etc., and you were willing to accept this, not just because you got 120, you were willing to accept it because I convinced you that I was going to be good for your company. I had plans. I was going to have some synergies with other companies. I was going to break into China. I was going to into the Chinese market. I'm going to use the blockchain. Think about the terms that Demoter said, create value. Okay. And what was the third one? Was it just the word synergies? China, blockchain, and the word synergies all by itself increase value. As you're talking about the story of the company. I convinced you. And maybe part of what I did was I realized I could get rid of some employees. I could consolidate some operations. I could squeeze some suppliers. And I could create a better EBIT. And all of a sudden, if I created a better EBIT, maybe it wasn't 8, maybe it was 30. And now, if I've got $4 million invested, really, against a $30 million value, what's my return on investment? It's many times, right? It's not a percentage that's measured at, in less than 100. It's many times. Mikkel?
If you would do this and you're not able to pay anymore, could you just like bankrupt that company and then take all the risk? So basically you can do this without any risk?
Yeah, absolutely. So here's where some LBOs end up, and some M&A transactions, and sadly some private equity transactions end up. And it's why some raiders get bad reputations, and why some private equity and LBO guys have bad reputations. So we get to the point where we realize, you know what? Yeah, I can continue to run this thing. I've got a $10 million interest expense. Maybe I'm only down, maybe I haven't run it as well as we expected it to, or I don't think it's really going to happen. I am going to, I'll only be able to do a break even on a taxable income basis, and I don't like that maybe. So what do you say? I'm going to now give myself the other 24. So now I have, so I'm going to take the 4 minus the other 24, so now I've got a negative $20 million investment, which means I got more than I ever gave. So I'm doing okay, right? I'm doing really well. And I bankrupt the company and let it be sold off for its separate parts. That happens. Or I don't do that. I don't bankrupt the thing. I just go ahead and realize that, the U.S. operations are worth $30 million. The South American operations are worth $40 million. This plant in France is worth, and I can sell off its disparate parts to other companies for more than the number. Remember, the sum of the parts greater than the whole concepts. I can do that. So you see these kinds of break-aparts of companies when the raiders' plans don't work out the way maybe I convinced the seller that it would work out. Because you never, ever would have sold to me if you thought I was going to A, BK the company, or B, sell off its disparate parts, right? Because all of your employees are now out of jobs. So there's lots of outcomes to these things.
I don't understand how they can just give themselves more cash than what they put in.
Why not?
So just
If I own,
you're just like,
if I own 100% of the
taking
stock,
half of it.
I own 100% of the stock.
It's just messed up.
Who? I am the board of directors.
Okay. But
Yeah, I've hired you guys because you're my friends. But I'm giving you $100,000 salaries because you're my friends. Show up at a meeting in Maui twice a year. You come in on my private jet. Are you going to tell me no? Am I being a little obtuse?
Right. Conceptually, so if in bankruptcy, you just need to make sure you pay salaries, right? And that's it. If
Well,
you
I gave myself the cash before I took it into bankruptcy.
So if there's
Now
no
you're-
money to pay, there's no legal ramifications for that?
Well, a bankruptcy judge could claw it back. And they, more and more often, are more aggressive about doing so. But it was my company. And my fiduciary responsibility is to the equity shareholders, to me. It's not to the debt holders. Not to the debt. Now, there was still enough company. Then when we liquidated everything else, the debt got paid off, the employees got paid. I did really well.
What about the bank?
What bank?
The one that you get,
He had that.
You declared bankruptcy.
that?
Bankruptcy.
Oh,
Middle finger. no?
so when I declared bankruptcy, the company was sold off in its disparate parts, and that sale brought about enough money to pay off the debt. I didn't take all the value out of the company. It still owned property, equipment, patents. It had customers. It had accounts receivable, inventory. All I did is I raided the cash. And I put it in a position where it couldn't afford to make its interest payments. Now, I'm telling you the ugly side of this, the dark side of private equity. When we work through the model together on Monday, you'll see the bright side. There's a reason I developed a couple of private equity funds and they got to come play with you fine people, okay? Because the dark side doesn't have to be experienced. And not just that it benefits the private equity people or the raiders, it can benefit all. We'll talk about it.
In leverage buyouts, are they usually just used as collateral against the debt, would you say? The company?
Say again, please.
Would the company and the leverage buyout usually just be a piece of collateral for your company? That you
Yeah,
usually
yeah. So the corporation, remember, it had no debt, but it had value, so presumably it had some assets,
So you
right?
usually use it
Those
against-
assets and the company were the collateral for the debt.
Okay, and then another question is, do you need to have 100% of the company to do the stock? Because if you own over 50%, 51%, you kind of do own the board, so to speak. It depends how it's set up, right? But can't you do the same hostile not hostile takeover, but it kind of is. Are you allowed
All
to-
you need to own is majority.
Yeah, so could you do exactly anything? You don't need to have 100%.
Yes,
This is going to be
It's
probably
harder.
Yeah, harder.
because if I've got 51% and Kira's got 49, she doesn't have majority say, but she probably can convince a judge that what I'm about to do is damaging to other non-fiduciary oriented stakeholders,
Okay.
like employees, bondholders, suppliers and such. 20 years ago, she would have never been able to press that argument. Today she can, yeah, because we're coming to realize more and more the value of non-equity stakeholders. All right, we're going to go through a model that will help you guys see how these decisions affect value and where you run into trouble and where you just create value. Okay, we'll do that on Monday. Let me give you a problem set. This is a project investment selection. This uses the concepts developed in IRR, MIRR, etc. This shouldn't be challenging for you, but I hope it'll bring back to your memories some stuff before you go on grade. In fact, just pass these along and then back into the back row. And let me give these then out. Thank you. Want to do that to Bobby, please? And to Mason. And then Bergen, these are yours. And CEO Banker Power. How many of you guys know Alex outside of class?
I do. He had surgery.
I know. I just want to make sure you knew that having surgery.
Yeah, that sucks.
And any way you look at it, that's Ryan. Any way you look at it, that's not fun.
Yeah.
I don't care who you are.
Oh, jealous. I wanted to get one he brought up. Do you know if that Matt Krause, is that his name, teaches in the spring or fall?
I think he does advanced investing topics in the spring. Really good class.
Yeah, I think I want to take that.
Cole.
I'm jealous, dude. That's so interesting.
Thank you.
I don't know.
Do you know how much it costs to audit a class?
Are you done on this, right?
I am, thank you.